Hey everyone, it's Nick. Welcome back to my channel. Should you invest in the S&P 500 index or the total stock market index? This is a question many people face. I know I did when I was getting started. We're going to look at the details of these two indexes and why you would invest in one versus the other. We're also going to look at the options for investing in these indexes via ETFs or mutual funds from Vanguard and Fidelity. Before we start, I must warn you, there is one thing many investors forget to do, and it is a huge mistake, and that is forgetting to smash the like button for the YouTube algorithm. Seriously though, if you enjoy videos like this, please smash the like button, subscribe, and hit the notification bell. It helps support free financial education on YouTube. For the comparisons in this video, I am going to use Vanguard's ETFs. For the S&P 500 index, that is VOO. For the total stock market index, that is VTI. We'll talk about other funds later, but they are all very similar. First, let's talk about fees. Both of these funds are diversified across hundreds or even thousands of individual stocks. There is a cost to managing this, and that is passed to you as a yearly fee. Both VOO and VTI have the same annual fee of 0.03%. To put that in perspective, that is 30 cents for every $1,000 you have invested. This is very cheap if you ask me for the value you're getting. It really makes me want to smash the like button. The most important thing when it comes to understanding the difference between the S&P 500 index and the total stock market index are the benchmarks they track. When you invest in an index fund, that index fund is attempting to track the performance of a benchmark. For the S&P 500, it tracks the performance of 500 of the largest companies in the US stock market. This index is managed by S&P Global. Stocks must meet certain criteria to be included in the index. There is a committee that meets quarterly and determines which stocks should be added or removed from the index. These are typically pretty small changes with just a couple stocks getting swapped. The Vanguard Total Stock Market Index tracks the performance of the CRSP US Total Market Index. CRSP is a company spun off from the Booth School of Business at the University of Chicago. Stocks must also meet certain criteria to be eligible for this index, but there is no limit to the number of stocks that are included in this index. CRSP has placed emphasis on cost efficiency and has implemented strategies to minimize the risk of investors arbitraging or front-running the index. This is one interesting factor, as companies often see their value go up drastically when they are added to the S&P 500. We recently saw this with Tesla, where it shot up when it was announced it would be added to the S&P 500. This creates the opportunity for investors to buy Tesla in anticipation of S&P 500 index funds adding Tesla to their portfolio. CRSP employs many techniques to minimize this risk. Next, let's look at the composition of these two indexes. VOO contains 508 stocks, while VTI contains 3,590 stocks. VTI is a superset of VOO, meaning it contains all 508 stocks in VOO and an additional 3,082 stocks. VTI is more diversified. However, both of these are market cap weighted indexes, meaning the largest companies make up most of the index. The extra 3,082 stocks make up only 20% of VTI. This means that 80% of VTI is basically equivalent to VOO. Here are the top 10 holdings of VOO and VTI. As you can see, they are the same companies, but the top 10 holdings represent about 28.9% of VOO and only 23.7% of VTI. Next, let's look at the equity style. Here are the equity styles of VOO and VTI from Morningstar. This helps us better understand the difference between the S&P 500 and total stock market index. Stocks are categorized in two general dimensions, size and value. The best way to understand this is through this equity style visualization. Let's dig into how to understand these. The first dimension is size, and you can see small, medium, and large on the left. This reflects the size of the companies that make up the fund. This is based on the market capitalization, which is the total amount of money invested in the company. For instance, Apple is the largest company with a market cap of $2.08 trillion. The next dimension is based on value, blend, and growth. A growth company is one that is expected to grow significantly. Tesla is an example of a growth company. A value company is one that is typically growing at a slower pace and may be undervalued. An example of such a company is Comcast. Comcast will likely grow much less than Tesla, but it is a profitable company and may be a better value. There is generally a premium in stock price for high growth companies. Blend is in the middle of value and growth. Once we understand these two dimensions, the equity style is a great visualization of the difference between these two indexes. You can see VTI has more medium and small companies. This gets you a broader exposure to the entire US stock market. Smaller companies are generally more risky than larger companies. However, some people believe smaller companies will have a higher return due to having a higher risk. Both of these indexes are very well diversified. However, I prefer the total stock market index. It is slightly more diversified and provides exposure to the entire US stock market. You may be more comfortable with or prefer to stick with the large companies. In this case, the S&P 500 index is a great option. In fact, in my employer's 401k and HSA, I invest in the S&P 500 index because that is the option. They don't have the total stock market index. They do have what's called the extended market index, which provides exposure to the additional companies that aren't in the S&P 500. However, I prefer simplicity. So rather than add another fund to my portfolio and have to figure out how much to put in the S&P 500 and how much to put in the extended, I just keep it simple and stick with the S&P 500. I may change my mind later as I really like getting exposure to the entire market. However, I really value simplicity. You may have noticed I haven't talked about the performance of either of these indexes. They perform pretty similarly, considering 80% of VTI is basically equivalent to VOO. Past performance doesn't guarantee future performance. I really believe your investments should be based on strategy, not on past performance. My strategy is to get exposure to the entire US stock market, including the small companies. In addition, I tend to believe that over the course of my lifetime, having exposure to the smaller companies will give me a slightly better return. I could be wrong, but this is the strategy I have chosen. I don't just look at how they've done in the past 10 years. I might look at the past 50 or 100 years to help guide my decision, but I'm not basing it solely on past performance. There are many ETFs or mutual funds in which you can invest to get exposure to the S&P 500 index or the total stock market index. We're going to look at the main options from Vanguard and Fidelity. Vanguard offers an ETF and a mutual fund for the S&P 500. They're basically equivalent and are the same fund. One's just an ETF, the other is a mutual fund. The ETF is ticker VOO, and the mutual fund is ticker VFIAX. Fidelity offers a mutual fund ticker FXAIX. For the total stock market index, Vanguard also offers the fund that's available as an ETF or mutual fund. The ETF is VTI, and the mutual fund is VTSAX. Fidelity's version is FSKAX. Note that this tracks a slightly different index, the Dow Jones US Total Stock Market Index. In practice, this has been nearly identical to the CRSP index. The fees on these index funds are all very low. However, they may vary slightly depending on ETF versus mutual fund or Vanguard versus Fidelity. The different funds will have different investment minimums. One of the great things about Fidelity's index funds is you can invest as little as $1. Anybody can get started investing in these funds. You may also see slightly different versions of these funds in an employer 401k or HSA. There are institutional versions of these funds that are only available in such plans, and they typically have even lower fees. Fidelity recently announced several zero-cost index funds, and they do have options that are comparable to the S&P 500 index and the total stock market index. These are based on proprietary indexes, which Fidelity designed to be low cost and allow them to deliver a zero-fee index. The large cap index is ticker FNILX. This is comparable to the S&P 500 index. The total market index fund is FZROX. These are not proven benchmarks, but should perform similarly to the other indexes. In general, I think any of these would be great investment options. It really comes down to a personal preference, whether you prefer ETFs or mutual funds, or whether you want to invest at Vanguard, Fidelity, or another brokerage. If you're using the ETFs, you can really buy them at any brokerage. With the mutual funds, you typically have to buy them at Vanguard or Fidelity, or you might be paying a higher fee. I use both the Fidelity and Vanguard mutual funds, and I have a few $100,000 invested across the S&P 500 and total stock market indexes at both companies. I prefer the total stock market index, but I'm content with the S&P 500 index if that's what's available. Once you determine which US stock index you prefer, you should consider if you're going to invest in international stocks. I made another video detailing the pros and cons of investing in international stocks. I'll put a link up here and down below. I also made another video on asset allocation discussing how you could diversify across different asset classes using just 3 or 4 index funds. I'll also put a link up here and down below. Make sure you comment below and let us know whether you prefer investing in the S&P 500 index or the total stock market index. If you got value from this video, don't forget to smash the like button and then subscribe. It helps support free financial education, and it makes it more likely that YouTube shares it with more people. Thanks for watching, everyone. Later.